Greetings and welcome. I'm Dr. Denver, and thanks for checking out my fifth presentation on basic accounting in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners, using the chart of accounting. This session presents an overview of concepts presented in Chapter 4, Elements of the Balance Sheet. It centers on a typical balance sheet format reported and published in a firm's annual financial statements, showing the titles and amounts of the major general ledger account categories or elements shown in a stacked format used to perform horizontal and vertical analyses across different accounting periods. The balance sheet statement shows the titles and summary total amounts of the major accounting categories for assets, liabilities, and owner's equity sections of a business's chart of accounts, and is also a representation of the accounting equation total assets equals the sum of total liabilities plus total equity. The titles of the categories and related total amounts shown are the top levels of the categories' hierarchies. A firm's chart of accounts is usually created to accommodate two or more subcategories for each main account title shown on the balance sheet. Categories in the balance sheet are shown in the order of most liquid, that is, the ease of conversion to cash, to the least liquid. Assets are subdivided into current assets, long-term or fixed assets, and intangibles. Asset accounts in the general ledger normally have debit balances and are reported on the balance sheet from most liquid to least liquid, with the most liquid asset being cash. Liquidity refers to how quickly the asset can be converted to cash. Current assets are expected to be used up within the normal operating cycle of the organization, or 1 year, whichever is longer. Examples of types of current assets used by firms are cash and cash equivalents, accounts receivable, allowance for bad debts, and merchandise inventory. Long-term assets or fixed assets are expected to be useful to the firm for more than a year and expensed over a period calculated to match revenues directly or indirectly generated by such assets. They include office buildings, office furniture and equipment, machines, computer equipment, land, vehicles, warehouse equipment, etc. Fixed assets are required to support the operations of the business over an extended period of time, a year or more. Accumulated depreciation is the contra asset in the balance sheet for the accumulated depreciation expense recorded in the income statement to expense the cost of long-term assets. Intangible assets are long-term, non-physical assets such as goodwill, copyright, patents, trademarks, and licenses,